Hey folks, welcome back to Honey Money SG. So we have finally arrived to the second half of the year. It's the month of July, and that means another update on my Syfe portfolio. So I do have two portfolios with Syfe. One is the Syfe Wealth, where it's more like a robo-advisor where you pick your portfolio risk and the expected returns that you want to get. Then Syfe will kind of automate which kind of portfolio is suitable for you. And also I do have another portfolio with Syfe Trade, which probably acts more like a stock brokerage, like a custodian, right? Because you will buy stocks through the Syfe Trade app and then you'll hold the stocks through Syfe as the custodian. And let us just have a quick recap of what happened during the first half of the year. Because if we look at the indexes, especially the S&P 500 and the NASDAQ, the S&P 500 has fallen to around 3,800 point range, which means from the year to date, we have fallen almost like a 20% drop, which is pretty brutal, right? I mean, if you look at the news, it says that we suffered the worst first half of the year since 1970, and that's like more than 50 years ago. Can you imagine like how many of you are actually having unrealized losses in your portfolio right now, seeing all your gains in 2021 wipe out? And that's just the S&P 500, you know. We haven't even talked about NASDAQ that crashed like 30% off YTD. This is the index that tracks like the technology stocks like Google, Apple, Facebook, Amazon, all these kind of big tech companies. So seeing your portfolio drop by more than 30% is indeed a scary time for a lot of you. And I think it has been a long time since we see NASDAQ index at 11,000 range, right? Previously, in year 2021, it was hovering like 14k to 16k at its peak. So yes, the first half of the year has been really brutal to a lot of us investors, and many of you may be really shaken with fear. But I'll share with you my Syfe portfolio return as of now, because I do update my portfolios every 2 months with Syfe. Let's go. Alright folks, so this is the July Syfe update, and let's start off with my first portfolio, which is the Diamond Hands Syfe Select Custom portfolio. And you see it's not been doing really well. In fact, I only invested $3,300 since the late last year, and now the market value is around $2,700. And you can see that my portfolio return right now is actually a loss of negative $570, which is really bad, right? If we look at the time weighted return, it's like a loss of 14.5%. Now this is even after a positive currency impact of $88. So because the USD has appreciated, but overall it's still a loss, right? And if you want to know what have I invested in this Syfe Select Custom leading to its poor performance, then I want to show you right here. So this is what I invested in, mainly in 3 ETFs, which is the CSPX for S&P 500 exposure, the VWRA for all world usage ETF exposure, as well as the QQQ for a tech sector exposure. All of it was in equal percentage, but now since the NASDAQ has fallen that much, it has fallen to around 32% allocation, and then the S&P 500 is around 34% allocation. The remaining 0.25% is held as cash to pay for your management fees paid to Syfe. So overall, it has been a really bad performance, right? I don't think anyone was spared from this massacre since the start of the year while we were entering into a bear market, and you can see from my intro that I talk about S&P 500 falling to 20%, NASDAQ falling 30%. So definitely your portfolios will not look good even if you use this kind of ETFs. But for those who are not on Syfe Select Custom, then maybe you want to look at Equity 100, because I think it was one of the most popular portfolios last year, where the Syfe was heavily promoting Equity 100 as one of their best performers. But I guess due to market conditions, it's not doing well either, because the current market value is around $900, even though I invested around $1,000. Okay, so the loss impact is actually like negative $144, which represents a time weighted return of negative 12%. Really bad, right? I mean, people invest to make money, but you know, if you started like last year, which was a really bullish year in 2021, this year with a bear market, you're definitely at a loss. So let's take a look at what are the composition surrounding the Equity 100, mainly because it is in QQQ, and you know that QQQ from my intro, it has fallen 30%. It's going to take a big hit, right? Likewise for the S&P 500, but this time it's more of the equal weight ETF. S&P 500 has fallen also. So maybe the saving grace right now is China, because despite us talking so bearish news about China last year, I think they may be coming back this year when the China economy actually opens up. So maybe this may be the saving grace of the Equity 100 portfolio, who really knows, right? and then this is the normal S&P 500 CSPX again. The rest are in much smaller percentages, so I won't go through them. So overall, if you really want to diversify exposure, maybe you can look at the equity 100, because I think each ETF is only like around 10%, okay, for the larger components, and then for the smaller components it's less than 5%. So you're heavily diversified into a lot of ETFs around the world. Lastly, let's take a look at the REIT portfolio, right? Because this is what a lot of you sign up for the Syfe, having a lot of exposure to different REITs across Singapore. But even so, it has not been spared either, because I invested around $1,000, and right now it has a loss of around $44, which means it's like a negative 4%, which is considered quite mild already if you compare to the US market. And maybe you may see that where is my invested amount, because my invested amount has reduced to 0. That was because I have been withdrawing all the referral fees, the referral benefits from this portfolio to like give a fair comparison, right? Otherwise it would be really inaccurate to include all the referral fees as income. So let's take a look at the REIT composition right now. Ascendas REIT will be the largest component, which is around 10%, followed by CICT at 10% as well, and then we have your Mapletree family like Mapletree Industrial Trust, Logistics Trust, and Commercial Trust, followed by Keppel DC REITs. So all these top few components are really like the blue chip REITs of the Singapore market, right? We don't really see like those rubbish junk bond REITs. So I think at least Syfe is doing quite a good job on the REIT Plus portfolio management. But maybe the next opportunity may be in hospitality trust as Singapore open up to more tourists, and many of them will need to stay in our hotels and resorts in the island. So that may bring a rise to an increase in hospitality business anyway. So yes, this is my overall portfolio review of the Syfe Wealth. My Diamond Hands portfolio for Syfe Select Custom not doing well at negative $570. My equity 100 not doing well either, lost like 10% from $1,000 to $900. My REIT Plus portfolio also not doing well, losing like 4% from $1,000 of invested value. So that's for Syfe Wealth, right? Because I have not been putting money dollar cost average into this Syfe portfolio since the start of the year, as I have placed my focus on Syfe Trade. So you may want to refer to my Syfe Trade following on. So folks, this is my Syfe Trade platform, and let's move on to my portfolio directly. Okay, and you can see that I actually have a new holding. This is actually QQQM, which is the NASDAQ 100 ETF. So why did I diversify away from Google? Now, as you know, Google is coming to a stock split, or 20-to-1 stock split. That means that Alphabet or Google stock will be split to a $100 range, which is quite accessible for everyone to purchase in smaller units. So I think there's no point to actually buy fractional shares anymore. And also because I think I want to diversify away from stock picking, because I am a terrible stock picker, and I rather just invest in the index fund like QQQ or QQQM, okay, a tech focused ETF that allows fractional trading on Syfe Trade. So maybe I'll just hold on to my Alphabet investments within Syfe Trade. I'll just let it sit there. And Google has not been doing well either. In fact, I've lost around $339. Okay, my average price is around 2.6k at 0.76 quantity. This is pre-split pre-split at around the market price of $2,175 right now. So quite disappointed with Google, but I guess it's just market sentiments. In fact, the 52-week high for Alphabet when they announced of the recent stock split news is around $3,000, okay, and it has now fallen to a range of $2,000. Okay, that is like a 33% drop, which is really like a market crash. But the business of Google is still pretty good, right? If you look at the revenue, it's like 15% growth. EBITDA is 33% growth. And if we look at the analyst ratings here, 40 of them still consider Google a stock to buy at current prices. And then these are what analysts estimate Google price to be, okay, within the next 12 months. So a low estimate will be like 2.6k, average will be 3.1, and then the high estimate will be 4.5. Wow, 4.5, I think really a bit too far-fetched. So this is what Syfe tells you based on analyst estimates, not what I tell you. And this will show the PE ratio. You can see that the PE ratio of Alphabet has really fallen so much. You see, last year it was at a high of around 30 PE. Now it's like 18.9 PE or even 18 PE. Okay, Google is really cheap right now if you consider the PE ratio. But I guess that's it for Alphabet or Google, because right now I'm going to place my dollar cost average every month into QQQM. So what is QQQM, you may ask? It's like the same 100 components of the NASDAQ index, but it's cheaper, I think, for the expense ratio compared to the original QQQ ETF. Just that it is slightly less liquid, Right now for the quantity wise, I have around 3.3 units, average price of $121, and that means an unrealized loss of $18. Right now the price is around $116 of market value. Okay, with my average price of $121, still not looking good. But overall, I think if you look at the NASDAQ downtrend, I think we are buying at the lows already. The $100+ range for QQQM. So I will continue to dollar cost average this, because if you look at the 52-week high is around $168. 52-week low $111. We are really near the 52-week low level already. So I think if you want to dollar cost average, it is preferred for you to do so to an ETF compared to an individual stock, because individual stocks are much more risky, right, compared to a diversification through an ETF. So that is what I am doing. I'm not recommending for you to do the same. You can follow or not, depends on yourself, your own decisions, your choices. Don't blame me for it if you lose money, because all these are not financial advice. With that, if you found value in my sharing with my Syfe Wealth and Syfe Trade portfolio, do remember to comment a thank you, and I'll greatly appreciate it. So let's get back to the video. Alright folks, so these are my two portfolios with Syfe Wealth and Syfe Trade, and I do want to share a bit about the referral program because it kind of have a little bit of update, and it's a good update, so let's get into it. Okay, so let's take a look at some of the new user rewards that you could get when you sign up for a Syfe Wealth or Syfe Trade account. So for Syfe Wealth on the left in gold color, you will actually get some of the excess fees or management fees waived according to how much you have deposited on your first deposit. So for example, if you deposited between $1,000 to less than $10,000, you get 3 months of excess fees waived. And then if you deposit like $10,000 to $19,999, you get like 4 months waived. So that depends on how much you have deposited on your first deposit. The more amounts that you deposit, the more months of excess fees will be waived. And then if you start off with the Cash Plus portfolio, there really isn't any reward for you, because Cash Plus is like not much benefit or profit for them. So I guess that may be the reason why there are no new user rewards. But for Syfe Trade, it's a totally different thing, right? If you deposited like at least $2,000, you get like $70 in cash credits. And I think that's quite attractive, right? I mean, if you sign up for new brokers, they usually give you like free stocks or anything. But Syfe gives you free cash, free $70 of cold hard cash, which can be used on your next investment or trade. And I think Syfe Trade is worth it, right? It's really like free 2 trades every month, and it enables fractional trading as well. So why not just consider using Syfe Trade for your first 2 trades of the month? So all these incentives and rewards are actually effective as of the 1st of July 2022. So it's a rather new offer compared to what you have previously before July. So you can see that you can actually get very good sign up gifts with Syfe if you start trading with Syfe Trade. And having Syfe Trade is more like having a sidekick, right? You don't have to make them your main brokerage. Of course, you can do that, but I think having more options is always better for us consumers and investors. So if you haven't signed up for Syfe Trade yet, do remember to use my referral code down below to get the sign up gifts. And also, if you want to look at how did my Syfe portfolio do like 2 months back, then I can refer you to watch this video because I did an update in the May. With that, thank you for watching. My name is Christopher. This is Honey Money SG, steering young adults to financial independence.